Welcome, everybody. I'm joined, as always, by Bob Dewey. This week, we have two special guests, Jack, who's now becoming a recurring guest, Jack Wright, and then Ed Mills, who I've known for many years. So Ed, right now, is running Washington policy at Raymond James, but for years, he was a very senior Hill staffer who was involved in various important financial regulation over the years. And then he also had a stop there in between at FBR. Jack, I know you were kind of the one that brought us all together to talk about both everything that just happened in the last week and a half, and then maybe we can dig into where we see things going. So from your perspective, you have a background in finance at J.P. Morgan and Merrill Lynch, but also now on working for the Post and writing about it. What are you seeing that the topics and is it understood by the public?
Yeah. Thanks, Brendan. Thanks for the kind introduction. I just think it's a fascinating situation for many reasons, right? The first is, trying to understand what happened and also how manipulation or change of various regulations leading into this particular crisis may have influenced the manner in which it unfolded. And I think that's the first important thing to understand, because it is instructive of what regulation going forward might need to look like in order to avert a similar scenario emerging again. And then I also think there's just, a whole raft of interesting conceptual discussions about how we manage this sort of risk in general, because there does seem to be a little bit of a pivot going on the regulatory side right now, where they're starting to look more towards this, what some people call the private sector solution for, bank insolvency, which is, effectively the banks supporting one another via pooling capital in some newly innovative ways. So I think those are, the really interesting sort of parts of the discussion. But I think we should kick off, just getting everyone's thoughts on what happened and how it was allowed to happen.
Yeah, I think that's why we brought Ed on. Both, this is what you do for a living, but also your background. You have very unique insights. I don't know. I guess for the lay listener, what happened? Why did I understand? It started kind of with crypto, but that was a false leading narrative. And what happened at Silicon Valley is very unique.
Yeah, I think I've been thinking about this in terms of, I feel as if I know what a virologist or an epidemiologist felt like in the middle of COVID.
That's interesting. Yeah.
You just kind of you look through and you kind of scroll through and oh my God, there's a lot of people who think they understand some of these issues and they have no idea what has just happened. Mm-hmm. They have no idea kind of some of the background and I think, I could come up with a long list of what happened and who's to blame, but I think there's a very human component to this. As there is always when there is a bank failure, there is a couple of different people who made some really bad decisions. And I think as we're kind of thinking about a reform to this, you can never legislate someone to do a good job. And so, the regulatory infrastructure is there for banks to conceivably be safe and sound, but you can't stop bank management teams necessarily from making bad decisions, or we don't want to regulate every decision a bank makes because then, we're not a capitalistic society. So, Silicon Valley Bank, some others made some bets that they should own treasuries and other really safe assets.
Yeah, that's an important point. It wasn't like they were buying, the tranches of the lowest equity level. They actually bought the safest stuff.
Yeah, because we fight the last battle in DC. So the last battle was all sorts of credit blew up, and so we need to make sure everyone has the safe assets. We came up with this new term called an HQLA, a high quality liquid asset. And what is higher quality and more liquid than a treasury than a U.S. Treasury? Nothing really out there. And so we had a lot of these banks do this. We can get into whether or not this was monetary policy decisions for years, but I think before you would put that on there, this is a failure of regulators, in their supervisory job. So you had a bank making bad decisions, but you had regulators that let them to continue to make those bad decisions. And then ultimately, when things got a little bit hairy, you had the customers of this bank make a bad decision in terms of, freaking out and having a bank run. And
well, I think that part is very unique now, especially from the regulatory standpoint. Because before, when you saw a bank fail, you kind of knew how to wind it up. But we've never had a bank fail in the time of kind of ubiquitous social media. Even 2008, we were still kind of in the early days of that, and Twitter wasn't as big of a deal as it was. So this time we really did have an online kind of bank scare that I think the regulators going into the weekend thinking, oh, we'll just have Silicon Valley fail and then, we'll move on like we always did. And
we've had Silicon Valley taken out in the middle of a trading day. Yeah. Like they couldn't even get to the close on the Friday. We had $42 billion worth of deposits leave the bank on Thursday alone. And so as we think about this, there's really no stress test that's been out there that says what happens if you lose $42 billion in deposits in an afternoon.
Yeah, when the day before everyone thought you were totally fine.
Yeah. I was talking to bank investors on Wednesday. It didn't even come up. It was like, oh, wait, Thursday, this bank could fail.
Yeah. I think there's two things that strike me about what you just sort of outlined. And the first is that I personally don't have an understanding, and I don't know whether there is information available about what the makeup of the full $250 billion US of assets looks like. So let's remember, right, that an asset for a bank is a liability for everybody else in the economic system, right? And effectively, it stands to reason that if these guys have such a concentrated client book of high net worth individuals and corporations, that a ton of those assets are loans into the tech sector. And it sort of stands to reason that treasury position that they sold down, they may not have had a lot of other options in terms of things to liquidate. Now, that raises a couple of interesting questions. One is about regulatory oversight and how you risk weight those assets on the balance sheet of a regional bank, given who the loans are made to. But the second question is that this may be the opening chapter of a whole new paradigm that people have worried about for a very long time, which is what happens when interest rates structurally widen post-QE. It's no secret, and there's nothing newsworthy in the statement that post-2008, the world has been flooded with money, right? Whether that's through QE in America, in the Eurozone, or Japan. But we still don't know. And the Wall Street banks, Jamie Dimon's been banging on about this for years. We don't really know what happens when rates normalize after a period of excess liquidity like that. And given that Silicon Valley Bank has experienced this hyper-acute failure, I do understand why regulators are being so proactive, because I think that the concern is that sort of stress could emerge in other sectors or in the economy writ large as central bankers continue to move policy rates higher and as tradable fixed income interests realize a wider equilibrium spread going forward. And that's a question that is really interesting. I think it's why the regulators are being so proactive right now about things like, come to us if you need any money, et cetera, just making all of those terms explicitly clear, probably because they can see this stress emerging elsewhere.
Yeah, and Jack, I think you make a really good point. If, sophisticated individuals don't necessarily know what the full kind of $200+ billion in assets are, that's not something that we should ask the average American to kind of peel back and do the due diligence on their bank. And that's why we have FDIC insurance. And that's why the uninsured depositors of Silicon Valley and of Signature Bank were made whole, because there was this sense that really wasn't up to those kind of customers of the bank to know that the bank had made some bad decisions or regulators had made some bad decisions. But now it's really a question of, well, do we do this for everyone? Do we pick and choose?
This really fascinates me because a lot of like the libertarians are now calling for the government to guarantee all deposits, but so they want a government solution. But am I incorrect? Isn't there a private sector solution to this? You have to pay for it, but isn't this offered?
Yeah, so I've been doing some conference calls with this company called Intrafy. It was formerly Promontory Financial, and it was founded by regulators.
Yeah.
And so they
came together after the crisis.
And it's like really took off after 2008, and it's it used to be called some broker deposits, but what they can do is that they have 3,000 banks in their network, which is essentially everyone. It's like those who are excluded are kind of some of the ultra big ones and a lot of smaller banks. And through their network, you can get FDIC insurance of up to $150 million per depositor, per tax ID. And so this idea that the only way we could possibly give more than $250,000 worth of FDIC insurance is just a red herring. And I think what I'm concerned about is that every time we have a crisis in this country, the only thing that we're turning to is, the Fed has to set up an emergency program. Congress has to have to set up a new, where is the private market solutions out there? And this exists, and banks, you talked about the cost of this is 12 basis points. So that is,
it's not egregious.
Like about 1/10 of 1%. We're in it, and it's been hard for some banks to offer this because interest rates have been so low, and the risk that people thought was also so low. They have plenty of customers now. Everyone's like, 12 basis points, I can kind of sign up for this and get a nice yield. Like, it's good, but let's remember, we have ways of keeping these core deposits within banks for really large customers of these banks. We don't have to think about a nationwide deposit insurance as the only solution to this crisis in confidence that exists out there.
Yeah. And is Intrafy an offer that individual depositors purchase? It's an insurance that they purchase, or is the bank purchasing it on behalf of their customers?
It is run through the bank, but when you kind of at the bank, if you want this, you opt into it. It's one of the products that you offer, and the bank gets to determine. Some banks might not want $150 million deposit because they're concerned about deposit flight. Some banks will offer 10 million or 50 million. What rate gets chosen? It's up to the bank.
Yeah, this does cut to the personal responsibility of the management of Silicon Valley Bank, because they ran a business that took enormous deposits from businesses that were uninsured, and they were not running their balance sheet in anticipation of the risk that they were taking on, because that, large deposits that are uninsured are hair trigger deposits. You don't want to count on them for the long term. If anybody loses confidence, that's the fastest type of money that can move. And then you layer on the social media effect and the panic effect, and you get a really incendiary combination that management, the risk side of the management team really should have been thinking through.
You mean the credit risk, the chief risk officer that didn't exist?
Yeah. He stopped showing. He or she stopped showing up about 6 months ago, I think. But another interesting aspect to what you're describing is that the Fed and other regulators do appear to be starting to adopt some elements of the solution that you're describing into their reaction to this problem. So, I find it really interesting to note that one of the acute responsive actions that's been taken is that some of the majors, Bank of America, JP Morgan and co, are migrating deposits onto First Republic's balance sheet and some other regionals, I believe, as well. And this is all being orchestrated by the authorities. The idea being that, they can effectively, do what you're saying. But it's super interesting to think that the cash flows of this situation look as follows. Bank of America took $15 billion of new deposits onto its balance sheet last week, right? That money is coming from the regional banking sector, because regardless of whether or not the regulator is able to quell the nerves of participants in the financial markets, retail investors are still going, why wouldn't I move my money into Bank of America or JP Morgan? Like what? Why? So as that happens, that capital is then just sort of being circulated back into the part of the system that depositors were trying to withdraw themselves from. Now, if it works, great, but it kind of feels like a little bit of a sleight of hand as opposed to what you're describing, which is like a much more clearly articulated, reliable, transparent process to try and reduce the overall risk of bank runs in general.
In a process that has FDIC insurance on those deposits that are ledgered over versus what we're seeing is uninsured deposits. But you'd have to highlight the fact that if we do a nationwide deposit insurance, that comes with a assessment, a fee. We charge, the FDIC charges for that. And so if you are one of these largest banks, you don't want nationwide deposit insurance because it's going to cost you a lot of money. You're going to have to pay the FDIC this. So I think it's a couple of issues here. One, they're hoping that they can restore confidence and avoid a bigger bill later on. And number two, I think there is a concern that as they recycle those deposits, what type of outlook is there for the bank that receives the deposits? That's going to cost that bank a lot of money. And the earning power of that bank is impaired. And so we see equity markets responding, not favorable to those in a way that we thought they were going to be. But this is, banking relies on two things, capital and confidence. They're trying to give them both. And regulators are really trying to make sure there's no taxpayer funds here, or at least direct taxpayer funds, opening up a different playbook than they used in 2008.
Do you think it'll work?
Maybe.
If you had to make a bet, if you're a betting man.
It will work. It's just a question of, do they have to do something else before it works? If we have a couple of more bank failures, we will have nationwide deposit insurance. And I think that what's really interesting is that, we're talking about the systemic risk exemption that allows them to potentially do this. That was put in place in 1991 under a bill called FDICA, the FDIC Improvement Act. And the reason why they put in the systemic risk exemption was to limit how often the FDIC steps in and provides deposit insurance, because they provided too much of it to uninsured depositors and to creditors during the savings and loans crisis of the late 80s, early 90s. And you're talking about, Jack, you have these institutions that are heavily concentrated in one area or one industry, and they have a mismatch between assets and liabilities. That was the savings and loan industry. We've done this before. It's like kind of this is the closest we've had to a crisis that kind of history is rhyming again. But the regulatory infrastructure probably needs to be updated even a little bit more.
Well,
you can't regulate someone doing their job.
Yeah. Another interesting one that we learned last week from our time with Macro Alf is that if you mark your assets to market, you're not allowed to put hedges against those. That kind of boggles my mind. So what do you call it? Silicon Valley did have some hedges on. They had about 17 billion. They ended up taking off. That's a separate story.
Yeah,
but on the main book, from a regulatory standpoint, you're not allowed to put a hedge if you've got it marked to market.
Yes, they held to maturity. Bonds.
Yeah, So, what we see with regulators is that we are always fighting the last war.
Yeah, exactly.
And even where over the last couple of years, we've really changed the way in which we can have banks build up reserves or release reserves, because it goes back to sometimes when you do those things, they can make earnings look better or worse. And regulators have always been concerned that banks are able to have rosier looking earnings that actually exist. And so if you are holding it to maturity and it is a treasury, that's going to be money good. Why are you hedging that to earn a little bit extra and goose your earnings? And
that makes sense.
So it's this bifurcation between safety and soundness and attracting kind of investors to your equity.
That's very interesting. There's always a story. Everything happened for a reason. When you see a weird sign, Someone put that sign up for a reason.
Yeah.
Yes.
And what do you guys think about the potential for this to, metastasize further outside of the US regional banking space? Like we've seen the first shotgun wedding of this crisis with Credit Suisse and UBS. It's not.
Yeah, I think that's an interesting question because
it's not Credit Suisse's first time.
No,
altar,
I know, because we've known that Credit Suisse has been a bad bank for a long time. And I'm wondering if Credit Suisse had, reminded us about how bad they were a month in the future, we might not have gone under, but they just kind of reminded us that they're fairly incompetent at what they do. In the worst possible week, they could have reminded us,
Right. And well, I guess that's my question is, do you guys, in your perception, is what's happened with Credit Suisse and UBS, is that kind of like a latent tail risk that's been sitting around forever waiting for the straw to break the camel's back? Or do you think that it's instructive of a broader liquidity issue that could emerge in continental Europe or elsewhere?
I think it's more the former. And I think
So do I.
Yeah. So, and I also think what's really interesting here is that when you put in place a whole new regulatory infrastructure, regulators get a little bit excited to try to use that. And one of the big stories coming out of this forced marriage are these AT1 bonds, which are, the convertible, the COCOs. So that after the financial crisis, there was this idea that we shouldn't bail out banks, we should bail in banks. There should be some debt waiting there that could be converted to equity, that could be in a first loss position. And on Friday, there was all sorts of volatility in those bonds. A lot of investors bought those because they were yielding more than you could get for government or other similarly situated, because they didn't think there was any risk. But they bought 17 billion of them as it relates to Credit Suisse, and they've been all wiped out. They're going to be written down to zero. And so this is yet again global regulator saying, yes, the infrastructure we put in place since the financial crisis is working, and we're going to bail in this institution. Part of the reason why Silicon Valley was not sold before it collapsed, I think, was that regulators not saying, last time when someone got in trouble, it went and got sold to one of these globally systemically important banks. We're not going to do that again. When Signature Bank got sold this weekend after it failed, it went to another community bank, New York Community Bank, which has merged with Flagstar, to show that last time's playbook is not what we're doing this time. We're protecting investors, and we're not letting the big guys necessarily get bigger without some level of consequence. If there wasn't that bail-in feature, it would have been a lot more questions to answer for those global regulators, and really brings into question, are debt holders going to get a haircut this time around, which got no haircut in 2008?
Yeah, and that's a great point too, because what the Fed had to, and the Treasury, everybody had to do over the weekend, it wasn't really to protect the deposits from flowing out of Silicon Valley. It was to protect deposits from flowing out of every other regional and community bank in America. It's structural.
It's a structural hedge they're trying to put on. It's not specific to SVB. That's for sure. What do you guys make of their decision, the manner in which they disposed of their Treasury holdings? It reminds me of Gordon Brown when he announced to the world he was going to sell down half of the UK's gold holdings a month before he did it, and the gold price halved. Like, why do you think that they chose to dump these things in the manner they did? And secondly, that they were so public about it. And thirdly, do you reckon it was worth the $100 million that Goldman Sachs charged them in advice fees for that strategy?
It's the longer I'm in DC, I kind of really ascribe to the view that never attribute to conspiracy that you can attribute to incompetence. And so I'm not making a call on the competency, but sometimes one of the I keep going back. It seems like a series of bad decision-making processes that led to kind of a domino effect.
Yeah, Ed and I always joke that,
but it's an error.
Outside of DC wants to think that House of Cards is what it likes down here, and really, Veep might as well have been a documentary.
Yeah.
But I mean, it's an error so basic, right? Like in terms of market activity, I mean.
But what else do they have to sell?
No, I'm saying do it like just dumping it all out into the market without going into some sort of consultation, about borrowing against it, potentially even confidentially with somebody they could.
Right,
You don't just open up your Bloomberg terminal, hit BBO, and sell $22 billion worth of T-bills in the screen, right? Like, obviously, that's going to cause a problem for you and for everyone else. But I just think it's interesting they decided to do that.
And how do we respond? Now, anyone who has any underwater security, that is a treasury, an agency mortgage, things that the Fed is happy to have pledged to them, they can get 100 cents on the dollar. And then they're going to play the spread trade. I mean, it's real. You can pledge it, get 100 cents on the dollar, and then go to the Fed discount window. It's kind of like buy Fed funds. It's there's so much kind of excess. This was I view kind of this new facility as a cheap equity raise for the entirety of the banking system if they use it.
Ed, correct me if I'm wrong, but that's planned to be, it's a 12-month operation for that, or at least that's the plan.
That's the plan. Yeah. And I think that what and we're not going to have names released until at least the end of those 12 months, trying to get some folks to use it.
Yeah.
And it's people kind of looked at it and they said, oh, it was a $25 billion facility. No, it's up to $25 billion in losses. And when you think about the losses that you would get on US treasuries, it's essentially an unlimited facility that can be done. Add into the new kind of easing on kind of dollar swaps lines. QE is back. Kind of the balance sheet of the Fed is going up versus the the overall kind of downward trajectory of the Fed's balance sheet.
Yeah, which makes their decision this week even more complicated. Irrelevant of whether you should pause the rate hikes, you're doing quantitative tightening with one hand and quantitative easing with the regulatory part of your
Well, I think what they're trying to do, it's like a positive gun threat, right? Like, whereas the previous programs of QE and the 2008 crisis and stuff were actually firing the bazooka. Like, it's kind of demonstrating to participants within the regional banking system and elsewhere in the economy that they are a last line of liquidity that is going to proactively try and stop any disorderly default pattern occurring, right? Like, it kind of reminds me a bit of Mario Draghi at the outset of the Greek crisis, right? I remember he said, "We will do what is necessary to maintain stability, full stop." And like that,
and that day was the low in the European.
That's it, right? I used to sit next to a guy at Merrill Lynch in London. It was his Bloomberg header. We will do what is required to maintain stability. And to me, there are elements of US regulation emerging now that seem to try to, deliver a similar message, which is, we don't need right now to pull out all the stops, but we're watching, we're proactive, and we're going to stop a crisis from emerging, which sounds like the right thing to do.
Yeah, well, the worst thing you can do is say that the banking system is safe and we don't have any losses.
As a CEO,
we did. Why do you keep reminding us? Newsom did it, and Yellen did it.
Yeah, you can't come out and do the nothing to see here. They've tried that before. It doesn't work.
Yeah, I think that the really interesting thing about kind of the Fed's monetary policy decisions from here is that what we see is that as the Fed funds rate goes up, lower yielding treasuries, the value of those go down. So if that was the issue that was at Silicon Valley Bank, that is no longer an issue for the system because you can always get par on those legacy securities.
Yeah,
so the Fed can still go up. And if the market reaction is stress on the banks have a way of kind of,
relieving that stress.
Wash, rinse, repeat of anything that they own. And I think the thing we also have to be very careful about here is the knives are even more out for the Fed today than they have been at any point since the financial crisis.
Mm-hmm.
And their long-term credibility is in doubt. Their power is in doubt. When we look at the 24 presidential election and congressional election, are we going to have candidates that want to change their power? People, probably haven't focused too much on the fact that the CFPB has a funding question before the Supreme Court.
Yes.
Well, but that's not necessarily about the CFPB. that could be about the entirety of the regional Fed system. That if you say that the CFPB can't get money from the Fed, how does the regionals kind of have the power in the funding that they have? And when we look at who is on the San Francisco Fed board, the CEO of Silicon Valley, you can regulate yourself. The entire independence and the structure and all this market confidence that we have in the Fed is up for doubt if they get this wrong.
Especially the regional banks, because it's kind of quasi-private public entities.
Well, exactly.
From a legal standpoint.
Yeah, and we almost took away the Fed's ability to regulate after the financial crisis because we thought, and this is in Congress, thought it was a conflict of interest. Now, on one hand, you need full employment. You need kind of price stability. And you are the regulator of all these mega banks out there. If you want the economy to do well, how much are you willing to pull in the reins? How much are you willing to slow growth? Do you let those banks kind of do a little bit more for longer than you normally would do if you truly had a separation between monetary policy and the regulatory powers of the Federal Reserve?
And that's fascinating, Ed. So on that precise point, do you think that looking midterm to long-term further out, this episode will generate a change in the capital adequacy provisions and the sort of core equity tier 1 ratios that are required for regional institutions versus major ones?
I think it's a bias upward for the entire system. You had Michael Barr, the vice chair for supervision, who gave the speech in December that said capital for the largest institutions are at the low end of the range. Last year, the highest CET1 is about 13.5%. And it's different based upon your stress test. But he was saying things kind of closer to that 16 to 18% range if you looked into his footnotes. I don't know if he can get there, but this kind of allows him a lot more push towards those higher capital levels. And then for regional banks, those between 200 to 700 billion and maybe all the way down to $100 billion, they're going to have those bonds that convert from debt into capital. And those bonds could get converted. So the cost of capital for regional banks is going up. And so if we look at some reassessment of risk, and this is what's been happening.
It should be higher though, right? It should be higher. The equilibrium funding rate for a regional bank should be a substantial positive spread on JP Morgan, right? I mean, that's the right level. It's the right trajectory, isn't it?
Yeah. But what does it do to our economy? Every extra kind of percentage of capital, that's, how much that gets levered up into the loans. So is that lower growth? The special sauce of the U.S. economy and innovation has been the fact that we have so many banks. So much of small business lending goes through these community banks and regional banks. Well, the reason why people have these relationships is because they get a response.
But you're absolutely right, though. You have to. The system has to take its medicine, and the medicine doesn't taste very nice. Like, these sort of reforms that you're talking about. You're right. The trade-off is with growth, and the problem is that when those decisions fall into the hands of politicians who've got a 2-year electoral cycle, then it's hard for. Sometimes.
Yeah, but now it's with a regulator that doesn't get elected.
Yeah, right. So if the regulator can get it done, great. Your point, right? Yeah.
But someone asked me the other day, was it a bad idea that Silicon Valley was so concentrated in one area? And my response was, that's basically the entire point of the middle to smaller size banks. Like if you're a bank in Iowa, you're going to bank a corn farmer. You want to specialize. Expertise, and that's the entire purpose of the way it's not that where we set it up, but the way our banking system has evolved.
It's definitely true, Brendan, but Silicon Valley Bank was a bit different in that you got Bill Ackman picking up the phone from New York City complaining about, right? Like it attracted capital later on, but your point is right. Like there will naturally be concentration risk in the banking model.
We have a regulatory response saying you can't have a concentration in a portfolio, which basically means you can't be a small bank.
But your point is right, which is that the whole business model of a lot of these small banks will naturally concentrate their clients.
It literally grew with the country. People didn't live out west until a couple hundred years ago, and with it, a bank got set up to do whatever it was that the people that ended up decided to live there did.
Yeah, I mean, when we created the Federal Reserve System, you kind of look at the population of the United States. We put 2 Federal Reserves in the state of Missouri. But west of that, we have one total Federal Reserve, which is San Francisco.
Yeah.
So it's like, I mean, it's like
Richmond still has one. Philly has one.
Atlanta has one. So Richmond, Philly, Atlanta, Boston, New York.
I didn't know Missouri has
Missouri.
two.
Yeah, it was the Speaker of the House
St.
was from
Louis
Missouri at that point.
And Kansas City. Yeah.
Oh, that's hilarious. Do you think there's any other like unforeseen consequences that might emerge in, say, next couple
or not even unforeseen? Like, where are we going to go? You know, both. This is, especially with Congress, this is creating some strange bedfellows. You know, where I'm not saying we're going to have next month a bipartisan bill on the Fed, but those risks are rising, and the regulators do have capability to just kind of do some things on their own, which they probably are going to do.
Well, can I jump in there just quickly?
Yes. What is your unforeseen?
One, you know, in my role talking to people in Congress, and I don't just look at finance, I report a lot on the politics stuff. And this issue appears to me to be emerging as the next, lightning rod that's going to be used for a partisan purpose to try and divide the electorate in the next election. So to the comments that you made, Ed, at the start of our meeting, like about COVID and now, in some ways, Jerome Powell is emerging as the new Fauci, right? In the way that he's being attacked.
Oh, lightning rod.
And,
exactly.
and I worry that the saner, cooler perspectives may unfortunately fall victim to this becoming another really nasty part of the political divide going into the next election, because it's got all of the elements that you need to stir up division, right? Rich people from Silicon Valley, everybody else paying the bill. And whilst a lot of the things that are said will be inaccurate, I worry this is going to turn into a partisan hot potato.
I think that's near guaranteed. It's what we do.
Yeah.
So we hope that we can kind of solve some of this while there's still this sense of crisis. But you are right, especially where Democrats would like to point to the deregulation that occurred under Trump.
Yeah.
And so Republicans are pushing towards some of the other requirements that have been pursued by Democratic regulators. Is it a focus on ESG? Is there other, is it the industry that was kind of concentrated here? Was it because it was tech? Would have you bailed out an energy lender in Texas in the same sense? Those are absolutely becoming battle lines that will only get deeper.
But what about on the capital side? Is the Fed allowed to, in their regulatory role, there's a process to it, but demand higher capital within the constraints of Dodd-Frank?
Yeah, I mean, it's like even for the stress tests, if you go back and look at the deregulatory bill, CCAR, which is the kind of big stress test that all the big banks do every year, that was a creation of the Fed. In one of the dynamics here, even on the conversation about unlimited deposit insurance, there's what they kind of are, told they can and cannot do, but there's always these exemptions. If you want to do something on safety and soundness, if you want to prevent systemic risks, you can basically do whatever you want under that umbrella, and they will do this. And there's not a lot that Congress can do to stop it outside being very concerned about the economic impact longer term for this economy. And maybe this becomes this will become a play of the 2024 congressional and presidential election, how much they're able to successfully get this through.
The one thing I think is very interesting that we haven't heard about any stresses in the credit card portfolios. Do you think that's because the Credit Card Act was perfecly written?
The Credit Card Act is the Card Act, as I will always, as it was a bill that I was the lead staffer on. I will always go back to there was a professor at the University of Chicago who they're not generally known for how much they like regulation. It was this professor who kind of wrote a paper on the 5-year anniversary that said the Card Act changed his worldview on regulation, that you can actually do something that adds consumer protections without harming an industry and without unintended consequences. So I think we did an okay job.
It was.
with that.
And I was being a little funny, but it is true. We don't hear about a lot of complaints about that credit cards anymore.
Yeah, if there is going to be an area for complaint, what I hear from regulators is CRE. We haven't gone into a credit cycle
massively, and we were going down that road anyways because people don't go to the office anymore. But this has just kind of accelerated that. There's pain to be coming in CRE portfolios.
Yeah, it's like kind of office and retail. But we if you go back even last fall, all of the regulators were in front of the House Financial Services Committee, in the Senate Banking Committee, and each one of their statements said, we are closely monitoring unrealized losses in securities portfolios of the banks. Yeah. Everyone knew that this was an issue. No one thought it was going to be something that caused any banks to fail. And so what's interesting to me is that how did we all know it without being concerned about it? And so because we all now know about CRE and retail and kind of the office space, is there going to be a situation where we start seeing some massive losses there that we go through a freak out, or are we in this world where I'm kind of tired of having a once in your career moment every 2 to 3 years these last couple decades.
It's a really good point, Ed, especially in light of the fact that I don't know if it broke today or yesterday, but the New York Times has a story on the front page today saying that the regulators contacted Silicon Valley Bank, I think it was 6 times in the lead up to this happening over the course of 18 months. And they issued them an escalating series of they're effectively requests for updated information to show that you've changed the position of the business.
Yeah, MRAs, matters requiring attention.
And then the last one they got was called an MRIA, matter requiring immediate attention. And then the whole thing fell over. So, but it's to your point, right? Maybe hopefully this is a spur that the regulators, that we get a bit more proactive on this stuff.
Yeah, it's and hope that we don't replay the movie Don't Look Up, where we all know the meteor is coming, but we're like, oh yes, we're all very much aware that this is a big issue. But
it's very funny film. Anybody who hasn't seen that should watch it. Very good.
Yes.
Well, that's probably a good place to wrap it, because then we'll come back in a month and we can discuss how the meteor is.
If the meteor hit or not.
But Jack, Ed, thank you so much. We definitely we'll keep monitoring the situation, and when we need to get back together, we'll do it.
Pleasure.
Thanks very much for having me.
Thanks, guys.
Good seeing you.
Likewise.
Take care, Jack. See you,
bye.
All right. Thank you. Stop.